Hey, welcome to the 40 Finance channel, everybody. My name's Jeff Beers. Today we're going to look at a handful of ETFs that, in my opinion, have a pretty good opportunity to bounce up from here. Now, I would classify most of these ETFs as sort of contrarian picks. Most of them have actually lost value here this year as we've watched the market melt down. So we are looking for low momentum opportunities, right? Stocks that have been forgotten about or cast aside. And if you believe things have a good probability to get better as opposed to worse when you think of inflation, supply chain, all the stuff that's going on, then the opportunity with these ETFs is to get in while the prices are depressed and ride that momentum towards a recovery, even if it takes 6 months, 1 year, 2 years. The magic of the market is to buy low and sell high in the perfect situations. And I think some of those situations on the low end are starting to build a bull case here. All right, so as always, we're going to be using Seeking Alpha for our valuations and momentum indicators. And if you're interested in learning more about Seeking Alpha Premium, my affiliate link is in the description below. You get a 14-day free trial as well as a significant discount on a 1-year subscription. All right, the first ETF on the board, if you watch my channel regularly, you're very, very familiar with it, and that is TQQQ. This is a 3x leverage version of the QQQ, so basically mimics 3x the performance of the QQQ, both to the upside and to the downside. Obviously, year to date, Qs have not been doing well, minus 20%, when then you multiply that 3x and you're down 60%. So the question before you spend any money on an ETF like this, you have to come to grips with what your projection of the QQQ tends to be. And switching over to the QQQ real quick, here's your top 10 holdings. So if you're going with the TQs, you're basically 3x'd on these companies, right? So how do you feel about the future for Apple, Microsoft, Amazon, Tesla, Alphabet, Facebook, Nvidia, Pepsi, and Costco? That's where your bull thesis has to be. Do you think that these names, which have run down 20% collectively as an ETF, it's actually 22.85%, do you think that that's a fair runoff? And that they're now fairly valued with limited upside? Or do you think that these particular companies have a bright future and they will make more money tomorrow than they make today? And in my case, I have no problem 3xing my bet on companies like Apple, Microsoft, and Amazon. Now, the key, of course, with any leveraged ETF is, of course, not investing more than you can afford to lose, just like the stock market in general. And in an ideal situation, I would say you would want a significant portion, maybe 30, 40% of your initial investment to remain in cash so that you can average down when we go through those periods of volatility. All right, the next ETF is similar in some ways to the first one. This is also a triple leveraged ETF from ProShares, but this one, instead of being focused on the top 100 NASDAQ stocks only, aka the QQQ, this represents 3x on the S&P 500 as a whole. So now you're starting to get into a little bit of a different view on things, right? And the big difference here, if we flip over to look at the holdings of the SPY, and we recognize that the UPRO is basically 3x times the SPY, right? And we go to the holdings breakdown, yes, you still have those battered down technology names, 25%, but you also have healthcare, financials, industrials, energy. Obviously, oil stocks are very hot right now. When you get into the top 10 holdings, you still have the top Apple, Microsoft, Amazon in the S&P 500, but the underlying names such as United Health Group, Exxon, things of that nature are in there. So with UPRO, you still have the high risk of the 3x leveraged ETF that also comes with high potential rewards. But I would argue that it's probably slightly safer then TQQQ, because you've got those oil stocks, those healthcare and industrials, at least building a base of the S&P 500, that will prevent it from falling as far as the Qs if tech continues to get beaten down. All right, next up, let's go international and let's talk about Chinese internet stocks, names like Alibaba, JD.com, etc. And for this, the KraneShares China Internet ETF, it gives you an opportunity to double down on some of the major losses that these names have had. And beyond fears of American delisting of Chinese stocks, you've also had China in the COVID lockdown, which has put further pressure on these names. But what's great about KWEB, and I want to show you this real quick. So here's your top 10 holdings. You got Tencent, Alibaba, JD.com, Baidu, etc., etc. But one of the things that you will notice about this particular ETF in terms of delisting risk is they actually hold ordinary shares or China-specific shares. So most of the names in this ETF are not ADRs. They're the actual like Shanghai listed shares. So that's not going to prevent you from taking losses if these stocks were delisted in America, because the broader company is going to take a hit. But at the same token, you are going to hold Shanghai shares, which will probably maintain at least some of their value in the absolute worst case scenario. Now, the bull case, of course, if you're interested in something like this, is just how far these names have been beaten down, right? So here's your 1 year, you're minus 60%. Let's see what year to date is. Year to date is minus 18%, but you've had a couple huge crashes in here, namely in mid-March, getting down to $21. This one is still very, very close to its 52-week low. So the hypothesis here is pretty simple. It is Alibaba, JD, names just like it, have been beaten down unfairly, and you are buying in now while they're down low because you believe over the next 6 months, 1 year, 2 years, whatever your time frame is, that the valuation of those stocks will continue to increase, and ultimately the valuation multiple will go up as investors are more attracted to join in these names. Now on my side, I'm buying small lots of KWEB with the goal to get to 100 shares or so, and then just let it ride for the long term, and we'll see if these stocks do indeed bounce back. Okay, next up is a consumer discretionary ETF that I personally own, the iShares IYC, which is Consumer Services ETF. And obviously, as we're in times of inflation, rising prices, there's a lot of concerns about where discretionary income will flow into some of the biggest companies in America, right? So if we look at the holdings here, you have your Amazon, Tesla, Home Depot, Walmart, Costco, Disney, Nike, etc., etc. What a lot of bears would say is that these companies are at prime risk, okay, prime risk to lose out on sales and potentially profits in the wake of inflation. And I think that that's a very rational opinion to have, right? But some things we know for sure about the American consumer and the American stock market from a historical basis is that any sort of ruts tend to be short-lived. And of course, we bounce out of them and continue on our charts of sort of up and to the right if you're looking at it from a graph standpoint. And if you think about the concept of reopening for many of these names, you know, we still are not going to have a normal year in 2022, right? We had restrictions, lockdowns, etc. in certain places of the country, January through March. So they've already missed the first quarter. As we get into summertime, it looks like, you know, we're going to be as close to possible as normal. I've seen the TSA traveler checkpoint stats are just barely below 2019 levels already. So summer's going to be big, and these are some of the biggest consumer spending names that you're going to find on the planet. and I look for them to rebound, maybe not in the short term of a month or two, but I think as you start to see Q2 and Q3 earnings come in, which represent most of the summer months, you might be surprised with how much the American consumer is spending in the summer. And you may also be surprised at how EPS numbers do, because these companies pass on a lot of the costs to the US consumer. All right, last one here. We're going to flip the script. Instead of going against momentum, here's an opportunity to go with momentum, and that is the PDBC, Invesco Optimum Yield Diversified Commodity Strategy. So long story short, commodities, and let me tell you a story about commodities as it relates to a K1. It's an additional form that you receive that you have to include with your tax returns each year when you're investing in commodities. And what's beautiful about this ETF is they've structured it some way, the math wizardry that they've done, they've structured it so you do not receive a K1. And the biggest advantage from a tax standpoint is just it takes K1s forever to get to your house. You'll get your W-2s, you'll get your investment statements, but these K1s float in April and sometimes after the filing deadline. So they can be a real headache, and that's really the advantage here. This ETF plays off the futures markets of certain commodities to try to bank off the spread of where the current and future prices are going to be, right? So if we go like on a 5-year horizon with this, you have to be in a strong commodity market in order for something like this to even offer you any kind of upside. We are obviously in that period right now when you think about oil, energy, agriculture, etc. All those prices are going up. And with this ETF, it's not about going from a $20 ETF up to a $100 ETF, right? They typically pay out their winnings or their dividends from the future markets throughout the year, assuming that they have them. So when you see these huge lop-offs, like here is November of 2021, this one was at 22, then it dropped all the way down to 14 or 15, and a lot of folks would be like, whoa, I would never get in that ETF. Look how quickly it dropped 25%. This was not a drop based on the performance of commodities. This was an actual payout from a dividend standpoint. So using Seeking Alpha here, we go back, last year's payout total, and I think there were a couple events that paid out. One of them was $5 and one of them was $2 or so, something like that. But last year, this one paid out $7.15. Now that's not guaranteed for 2022, right? This could be $1. We don't know. It all depends on the success that the futures traders have with commodities, and typically when commodity costs are going up, a place like PDBC is kind of a unique way to get a piece of it without trying to trade commodity futures yourself and not messing with K1s. So again, this ETF is going with the current momentum of the market. This is not a contrarian play. If you want to get in something like this, first of all, don't do any of these ETFs with 100% of your investing portfolio, right? Pick off little pieces, 10%, 20%, maybe even lower for the leveraged ETFs. But with PDBC, your hypothesis is that oil prices keep going up, wheat prices keep going up, natural gas keeps going up. If you do not see those prices increasing between now and the back end of the year, it's probably not going to be worth your time to get into this. All right, guys, so those are some intriguing ETF plays, in my opinion, that I see in the market right now. I think the best part about all of them is you're getting out of that single stock risk in this very volatile market, so your ebbs and flows are going to be a little bit more limited. And at the same token, if you're interested in high risk, high reward, and more of a broader hypothesis that this market is going to go up or down, then you can use those leveraged ETFs to play that game and satisfy the urge, so to speak, instead of buying a single stock that's down on its luck. Now, full disclosure, I think everybody knows I own TQQQ. I do not own UPRO. Okay, I do own KWEB, which is the Chinese internet one. I do own IYC, which is consumer discretionary. The last one, though, PDBC, the commodities one, I do not own. So I just want to share that with you. I'm going full contrarian during these times. I'm staying away from commodities. It doesn't interest me a whole lot. And when it comes to TQQQ and the leverage names, I'm keeping that below 5% of my total portfolio. So it's not this huge, like, all-in bet, right? It's more of a experiment and sort of a hypothesis that I have. So I encourage you to think about what levels you would invest in any of these ETFs. Now, before you go, don't forget to check out that special offer for Seeking Alpha, link in the description. Hope everybody's doing well. We'll see you on the next video.